Welcome back, one and all. This is your host, Will Gomez, for the Perpetual Pip, and it's time for another edition of Trading 101. Today, once again, we're stepping up our game, slowly but surely building up on everything that we've learned so far, and learning how to effectively and consistently capture profit in these markets. So, what we're going to be talking about today is how to effectively trade Fibonacci retracements. This is going to mark the difference between a novice trader and an experienced trader. So far, everything that we've talked about is the how and the why. Now we're going to talk about how to effectively get it done. Okay? Let's get into this in more detail. Okay? We've established how to determine which contender in the fight that we have going on between the bulls and the bears. We've established how to be able to figure out who is in the lead, right? Who's leading the battle. We've also established that the candlestick formations is how they're going to be communicating with us, letting us know when they're getting ready to make the next move. Now, candlestick formation trading is an excellent way to trade, okay? Particularly if you're looking to trade on smaller time frames and you're looking to be very active, looking to get in and get out aggressively with the market. However, we've already established that the market has a tendency to move in a Fibonacci wave pattern, right? The Fibonacci is the natural phenomenon that seems to follow us in nature and of course in the markets as well. So when you're just looking at the aggressive candlestick formation, it may not necessarily take into account the overall wave. So for those of you that are more experienced traders, perhaps you've gotten into a position where you see the candlestick formation, you get right in, and then all of a sudden that's when the market decides to pull back or go in the opposite direction. The reason for that is because we haven't been paying attention to the overall wave. It's extremely likely that we've just gotten in at the end of an extension. Okay, so the market has satisfied a D target, it's scored its target, and now the bulls or the bears are tired. They're getting ready to take a deep breath, relax a little bit, and while they do that, of course, the opposite team is going to press its advantage. So in order to kind of avoid that, following the waves, tracking the natural waves that tend to occur on the market is what's going to give us that additional edge to be effective with our entries as best as possible. We have to train ourselves to think in waves, all right? When we're looking at the candlestick formations, right, you can see here there are several bullish candlestick formations, but you can also see that not every single one of them leads to continued movement. If this had been the current market, this was a bullish candlestick formation, but shortly after that, all the market did was go sideways, right? Same situation here. The market went sideways for a while before taking off in our direction. We want to be cognizant of this. Trading candlestick formations, as I mentioned, is mostly attractive to scalp type traders, traders that are looking to participate on a very short-term basis, maybe for the duration of a session, 8 hours, or an entire day, but they're looking to get in and get out relatively quickly. Scalp type trading is fantastic. However, it may not necessarily lend itself to you as a trader because maybe you don't want to be in and out aggressively of positions. Maybe you just want to set it and forget it. Or maybe you have a life and you have other things that you want to do. Not everyone has the luxury of time to be able to sit in front of the computer monitoring this aggressively to make sure that the market isn't going to turn around all of a sudden. So since scalp type trading does involve aggressively interpreting the market signals, but also placing a really tight stop loss, the danger is that it's not necessarily paying attention to the overall waves. And so from time to time, you're going to get a situation like this where your stop loss is just way too close per candlestick formation rules, and you end up getting whacked out. And then the market goes in the overall direction that you expected. Okay? In order to avoid that, it's going to be imperative. It is the next level. It just is the next level. Tracking and accepting that the market moves in these ABCD or Elliott patterns. Okay, Fibonacci patterns. So this is just an overview of the retracement extension relationship that we talked about back in our Fibonacci video. We need to understand which retracements correspond to which extensions. And again, this is just an example color scheme. You can choose any color scheme that suits you best. Just make sure that you're pairing the correct retracements to the correct extension. Make sure that those colors match. Once again, we have the 236, the 382, the 50, and the 618. All of these retracement levels correspond to the 1.618D extension. Next up, you've got a slightly deeper C retracement, the 786. If the market comes down to touch the 786, the projected D target would be expected to be the 1.27. And lastly, if the market touches the 86, the projected D extension would be expected to be the 1.18. As long as the market bounces to any one of those levels, you know which projected D extension it's going to. If it touches the A, as we discussed, if it touches the A price or goes beyond the A price, that's a reversal. Different story altogether. But if we bounce at any one of these levels, we know where it should go. As long as that A-B boundary is intact, we've got a target. Okay? So, one last thing actually. When it comes to your A-B boundaries, a lot of traders kind of, another thing that will help you get an edge on this. Whenever the market gives you a super shallow, which is a 236, anything less than the 382 is considered to be super shallow. This right here, the 382, is a shallow retracement. So whenever you have anything less than the 50, these two levels, you have a very, very high percent chance that what the market actually is going to want to do is come down toward the deep C levels. The 50, 618, 786, 86, anything beyond the 50 is going to be considered to be a deep C. So usually traders that are Fibonacci type traders or that track these Fibonacci waves, they're generally looking for the market to at least give them a deep C before they seriously start to consider an entry. The entries, of course, are going to be determined by candlestick formations. Our knowledge of candlestick formations doesn't get thrown out. That is the way that the market communicates to us what it's going to do next. We're building on our candlestick knowledge and tying in the fact that the market naturally tends to wave, looking for these deeper C retracement levels for a much higher percent chance of success. So here's an example. This is a chart. This is a US dollar Canadian loonie chart on a 1 hour time frame. Once we have our Fibonacci in place, we're effectively able to track the A-B boundary. With our A-B boundary firmly established, as time goes on, right, because first we have to draw the A-B boundary based on the lowest low to the first high at the beginning of the uptrend, at the beginning of a downtrend, highest high to the first low, right? If you want more information on that, go ahead and view the Fibonacci video, how to plot Fibonacci's, earlier in our lessons. And then, of course, we track the C retracement. Now, as we discussed before in that Fibonacci video, the C is a variable. It always has to be the nearest point to the A price after the B. So if that's the case, our duty is to track that, and we're going to be looking for when the market satisfies one of the deeper C levels for the higher percentage chance of success. Now, what makes the Fibonacci difference here? The Fibonacci difference is that we look to place our stop loss at least 10 to 15 pips beyond the A. If it's an uptrend Fibonacci or a downtrend Fibonacci retracement, we always look to place our stop loss at least 10 to 15 pips beyond the A. Why? Because remember that that C is a variable. So as we track that bouncing ball, it's liable to change, to come down to deeper levels, and we want to be able to watch that, let the market come down to a deeper C if that's what it wants to do, without the risk of being knocked out, only to see the market go in our direction. So we want to be on the lookout for these deeper C levels before aggressively looking to interpret our candlestick formations. And the appropriate candlestick formations do have a tendency to start to form when these deeper levels are hit. It's not to say that when the market hits a 236 or 382, right, that the market won't form these candlestick formations, but the payout is going to be much more consistent after the market has hit one of these deeper Fibonacci levels. It's going to go to its expected D extension more often than not. So that's what we want to be on the lookout for In addition, since you're placing your stop loss beyond the capital A to try to give the market room to breathe and wave as it naturally does, the deeper you are closer to the A, that means you're looking at a smaller risk as opposed to entering in up here, placing your stop loss beyond the A, your risk increases, and you will have a longer ride to the target. So less risk, bigger potential reward, definitely going to be in our favor looking for an entry at one of the deeper retracement levels. Okay, this is how Fibonacci trading is done. You are bowing to the fact. All of this, I would say that trading on the markets is an exercise in humility. You really, really have to keep your ego and your pride in check. You have to recognize that you are trading alongside. You're not trading against. You need to be trading alongside these big institutions. They are very, very much so the sharks in this ocean, and we are just kind of the tiny remoras that are stuck to their side. So there's no way that any speculative trader, in my knowledge and my experience, and I've met some very wealthy individuals in my life, but there's no way that you're going to be able to keep up with a central bank or a large trading institution, right? It's just nigh impossible. So as a result of that, don't try to tell the market what it should be doing or try to call where the market's going to be going. Instead, watch it carefully. Know that the market moves in this natural wave pattern and allow it to do its thing. Okay, just be cognizant of that at all times. This is the magic of the Fibonacci, tracking the natural waves and putting your stop loss outside of the wave area to give the market room to be able to do what it needs to do. So that's our Fibonacci lesson here. If you have any questions, comments, concerns, please don't hesitate to email me directly, will@perpetualpip.com, perpetualpip@gmail.com. It would be my pleasure to work with you. Don't hesitate. You can also join us for our live trading sessions at perpetualpip.com. And of course, be sure to like and subscribe for additional free content, all of which is also available on our website. This has been Will Gomez for the Perpetual Pip. I'll see you for our next addition to this series, how to use counter trend lines to make our ABCD and candlestick trading that much more effective. See you soon.